As an investor, the key takeaway for me is the message that's been consistent from Powell, which is pedal to the metal, and they're going to continue to keep their foot on the gas and continue to provide support to the market. Obviously, primarily from the bond market, they're buying everything that's not tied down or nailed down, and that's providing the support to the market, but it's also impacting the equity market as well. So that's really the key message, and I think the markets are saying we will come out of this at some point. But while we are in the process of recovering from this and coming out of this, the Fed has our back. And while they have our back, we're going to be okay.
You know, Seth, we've used a lot of letters to describe the potential form or shape of a recovery here. All of those letters, I'm curious to see, are at the end of the alphabet. But Chair Powell sort of suggested that maybe while there are the inklings of a V-shaped recovery in some parts of the economy, that over time there will be other parts of the economy that will either have a W or a flat line and will come back much, much, much more slowly.
Yeah, I think what Powell's trying to hint at is there are some jobs where it seems like it should be reasonably easy. You lift mobility restrictions, you allow people to go do certain types of spending, and you see that come back reasonably quickly. We saw that in the retail sales report. We saw that to a lesser degree in the employment report. What I think he's worried about are the other parts of the economy, some of the services sectors in particular, where you will see for a long time people without their jobs. And when people don't have jobs, it crimps their spending. And you get this cycle, reinforcing cycle, where if employment is weak, it leads to weak spending. Weak spending then causes businesses to say, we probably don't need to hire that much more. And it continues the cycle. So I think that's the kind of dynamic that Powell is really talking about.
Yeah. How long, Seth, do you think it will be until the economy returns to what Chair Powell just said he would like to see, and that is February of 2020, before this all hit? Is that a multi-year return, a decade return? What do you think?
So probably not a decade. In our forecast, it doesn't happen to the end of 2022. But keep in mind that that's just getting back to the pre-COVID level. It's not taking into account that had this catastrophe not happened to the economy would have continued to grow. So it's just getting back to the starting point. It's not making up for that lost time. And I think that's a really key, sobering point to keep in mind.
Wasif, what does your economic view do to inform what you're doing or what you're recommending with respect to clients' money, asset allocation specifically?
Well, I think it really means that we need to continue to keep risk on the portfolio and allocate to risk. However, when we look at the makeup of the market, it still is, a very concentrated market with the top 5 or 6 names in the broader index like the S&P 500 making up a majority of the weight. And we've had many conversations about this in the past, Tyler, is that, last time I was on your show, I said the FANG 5 are enjoying their last dance. And I think that's still true, where we are enjoying that leadership for now, but it may be a process by which that comes to an end and a new regime begins. And the interesting thing to note is there are talks and ideas about an infrastructure spending concept. And if that becomes more of a reality, we could see that shift into the more cyclical type of names in the marketplace. So what we're doing in our portfolios is continuing to remain diversified with an eye towards the concentration and making sure that our portfolios aren't concentrated in those heavy names and are much more diversified.
All right, Wasif, thank you very much. Seth Carpenter, thank you as well.